Okay, it's showtime. Hi, folks. I have two questions for you guys. First, how many of you are sure that you're either are or will be paying the least amount of taxes when you retire? And two, how many of you would feel more secure in retirement if you knew that you were paying the least amount of taxes that you could? Well, if you're like most people, you probably answered no to the first question and yes to the second one. And you probably are concerned about whether you will have enough money in retirement anyway, and certainly do not want to be paying the government any more than you absolutely have to. So, if that's you, then you're really going to enjoy this webinar today. Also, I truly commend you for taking this precious time out of your busy schedule to learn about this really important topic. As you know, our topic for this webinar is taxes in retirement. And I couldn't be more excited about discussing this topic with you guys again today because it's definitely one of my favorite topics and because I can totally empathize with anyone who would like to pay less taxes, legally, of course, and is willing to put the extra time and effort into learning more about how to do that. With that said, I'm your host, Brian Dougherty from PLC Financial Solutions located in Fort Washington, PA, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hey, everybody.
Nice. Rachel's is going to be our moderator for it as usual, and she'll be handling the chat and Q&A boxes at the bottom of your screen. But before we get started, let's take care of some general housekeeping as usual. If the screen is not big enough for you to read, you can click on the View Options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen, one called Chat, it's for your comments, and the other called Q&A for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you guys will have questions about the material as we go along. However, since we have a good bit to cover, especially in this one, and only an hour to cover, maybe a little more, I'm going to ask you to put your comments and questions in those boxes below, or you can even email them to us at info@plcfs.com if it's easier for you while you're going along. Because at the end, we'll be staying for some extra time to cover as many of these as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link for you to schedule that at the end of the webinar. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it out again at your convenience. Also, because we want to make sure that you're all paying attention and because we'd like you to have some fun as well, before we answer any questions, we have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box or chat box will win a $10 gift card to a store of their choice for each question they get right. So make sure you have your handy dandy notebook with you to jot down some brief notes related to some special bullet points that I'll be pointing out as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor, and we only transact business in states where we are properly registered or excluded or exempted from registration requirements. Also, the SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attended a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. All right. So now that we have gotten that over with, I have one for you guys as usual. Why can't you explain puns to kleptomaniacs? They always take things too literally. I guess I'll keep the day job. Anyway, that was a new one. I looked it up today. All right. So, also, here are the mandatory disclosures for this particular workshop. Keep in mind, I am a financial advisor, not a CPA, enrolled agent, or an attorney. So the content in this presentation, the contents in this presentation are based on things I see day to day in my practice and are not specific advice for your situation. That said, many of the decisions that you make when it comes to your taxes will have tax implications related to them. So whether you use a professional or not to look forward at those implications is another story. But we at least want to show you how it's possible to do that in this workshop. Our goal is for you to leave here with a better understanding of how taxes are different in retirement, so you can avoid some very common tax pitfalls that some people make, if in fact you can. So these are the things that we will touch on today. As we go along, we'll discuss our current tax system overall and how the rules have recently changed with it. You'll definitely want to know about these things so that you can see how smart decisions when it comes to these can have a significant impact on your tax bill. Also, we'll be discussing how different income types interact between each other and can have a massive impact on the amount of taxes that you pay. Then finally, we'll discuss some of the things that you can plan for in order to reduce your taxes. One note before we get started, we'll be focusing on married filing jointly statistics because that's actually our most common attendees for these webinars. But for other filing statuses, such as a single or head of household, all the same principles still are the same. A reply. All right, folks, let's talk about the current tax rules. The current tax rules for ordinary income. Our tax system is what's known as bullet point one. I jumped right out. I got there before everybody. No one saw it coming, right? Bullet point one, write this down. Our tax system is what's known as a progressive or marginal system. Our tax system is what's known as a progressive or marginal system, which means that as your income increases, the rate you pay also goes up. Write that down. The most recent brackets instituted under the Tax Cuts and Jobs Act in 2018 actually lowered the rates of each bracket at each step, which is why many people have paid less in taxes in recent years. This tax chart you're looking at here is specifically for ordinary income as it relates to folks who are married and filing jointly. Bullet point two. Wow, 2 in 1 right away out of the gate. Bullet point 2. Get those handy dandy notebooks out. So what kind of income qualifies as ordinary? So what kind of income qualifies as ordinary? Well, it's income like wages. These are the types of income that qualify as ordinary. There's different types. Write a few of them down. Wages, most IRA withdrawals, pension income, rental income, interest from savings and investments, just to name a few. With that said, you must know that there are multiple types of income sources in the eyes of the IRS, and they are not all taxed at the same rates that ordinary income is, and thus have their own charts like this, which I will show you soon. But first, let's look more deeply at how ordinary income works. Okay, so this chart here might actually be an easier way to visualize the tax brackets for ordinary income. It's called a tax map because it illustrates the rate at which each additional dollar of ordinary income would be taxed. In retirement, two of the most common sources of ordinary income are pension income and withdrawals from IRA accounts. Notice from zero to about $30,700, there's actually no tax owed. Right here, zero to that's about $30,700 right there. And there's no tax charged on that amount of income. That's due to the new larger standard deduction and additional $1,500 each for a couple over age 65, which we'll discuss more in a few slides. Now, as you can see here, income levels between $30,700 and right around $52,700 fall into the 10% bracket. So that's from here to here, which means that only the income that falls in that range gets taxed at 10%. Now, for the income that falls between about $53,000 and $123,000, that's taxed at 12%. If those ranges look odd to you, it's because we've included the new standard deduction for married couples, which we'll discuss more in a little bit. Now, there are really three main spots on this map worth paying a little more attention to because of the bigger jumps that they make in tax rates. You can see they're pointed out by those three big green arrows. 1, 2, 3. The first is where it jumps from 0 to 10%. The second is where it jumps from 12% to 22%. And the third is where it jumps from 24% to 32%. They are the main areas where financial advisors like myself pay particular attention because it's when clients have income levels in and around those areas where some of the biggest tax planning opportunities lie. So that's why you may sometimes hear financial professionals talk about maximizing the tax bracket. What they mean is that it is good when possible to get the most income you can out of your accounts that incur taxes at a current rate or bracket before it moves up to the next bracket and starts getting taxed higher, especially those ones because they are the brackets that jump the most. A good example of this would be for folks who are under the current age of 72, because at the age the government starts to require that anyone, it's actually 73, anyone who has money saved in qualified retirement accounts like IRAs or 401ks, start withdrawing it in amounts that are dictated by the IRS. These amounts that are required might cause some people to move up to the higher tax brackets. So some people who know that this is coming will sometimes start to withdraw from their qualified retirement accounts several years beforehand. And they may do this right up to the edge of where the bracket starts to go up. For example, if they only needed, say, $60,000 in income from their qualified accounts each year, they may choose to withdraw $40,000 extra at that 12% bracket until they reach age 70, well, it's 73 actually. This way, the total amount that is left in their retirement accounts is so much lower by then, it will cause their amounts that are required to be withdrawn at that time to be much lower than they would have been, thus making it a lot less likely for them to fall into the higher tax brackets. Plus, They may even choose to put that extra $40,000 each year into a Roth IRA, which then is referred to as a Roth conversion. All right. I think that you now have a better understanding of how the ordinary income brackets work. Now let's talk about some of the types of income that are taxed different than ordinary income. Bullet point three. I jumped on that quick. Bullet point 3, get those handy dandy notebooks out. Now, let's look at both capital gains, which are generated from gains made on the sale of any type of assets or property that you can own and make money from, and qualified dividends, which is income paid to someone from shares of certain types of companies that they own for a certain period of time. So bullet point 3 is, what are capital gains and where they come from? They come from, 1, anything that's generated from gains made on the sale of any types of assets or property that one owns. And 2, qualified dividends, which is income paid to someone from shares of certain types of companies that they own for certain periods of time. Now, you'll see that these types of income have their own chart and brackets that are separate from the ordinary income chart and brackets that we just looked at. You'll also see that this type of income is taxed lower than ordinary income is. And that's because our government's public policy goal is to encourage people to invest in companies that are in our country and that contribute to our economy. Now, with capital gains and dividend income, they're still taxed, usually using a marginal tax concept in the same way that ordinary income is, even though the brackets for them are considerably different. Finally, prior to the Tax Cuts and Jobs Act of 2017, the capital gains and qualified dividend brackets were linked to the ordinary income brackets, but now they're not. They separated that. Okay, so let's take a look at these brackets. As you can see, long-term capital gains and qualified dividends that would usually fall into the 10% or 12% ordinary income brackets, if they were considered ordinary income, actually come through at a 0% rate on capital gains brackets, on the capital gains brackets. So now you can see why some people might be motivated to want to generate more income from this type of income source. Can also see that most people who earn capital gains income will be in the 15% bracket because of the income range being so wide, since it runs from $89,251 all the way up to $553,850. That's a big bracket, the 15%. Also, it's worth noting that the 20% capital gains rate applies to income levels that are right around where the old 39.6% ordinary income bracket would have begun, which means that the new tax bill that lowered the rates for ordinary income didn't actually dramatically change capital gains opportunities for high income earners. Okay, so here's a tax map that applies to only capital gains and qualified dividends. Meaning that if you had only dividends and capital gains on your tax return, bullet point 4, jumped in there, snuck it right in the middle, you would start paying capital gains tax at the 15% and 20% rates respectively. So, what are the two main capital gains tax brackets? The 15% and 20% rates. That's what the answer to bullet point 4 is. What are the two main capital gains tax brackets? And that's 15 and 20%. As you can see, you would pay 0% tax until you got to $89,251 in capital gains income. However, what most people don't understand is that how much you pay in capital gains tax isn't based solely on your capital gains income. Instead, it's based on your overall taxable income, which could possibly include both ordinary and Social Security income as well, and usually does, which is, as you'll see soon, taxed even differently than both ordinary and capital gains income. Talking about Social Security income there. So what I mean by that is that it is the combination of capital gains, ordinary income, and Social Security income all together that can cause capital gains taxation at the 15% threshold to begin much sooner than you would think from just looking at this chart. Also, again, as a note, this structure for capital gains and dividends really didn't change under the Tax Cuts and Jobs Act, except for the fact that the new larger standard deduction has changed the total taxable income range in a way that has helped most people to not start incurring capital gains tax until their taxable income is higher than it was. All right. So here's a couple of examples to show you how both the standard deduction and the combination of these classifications of income can affect your taxes on each. For this first example, to the far left, is a situation with a married couple filing jointly who are both 65 or older, who have $100,000 of capital gains on their return with no other types of income. This one's pretty cut and dry because they would end up paying zero federal taxes because they never reached the 15% capital gains bracket. Now, even though the 15% capital gains tax starts at $89,251 of income, what most people don't realize is that the real threshold before the 10% tax starts is $119,950. And that's because the standard deduction for a couple 65 and older that's filing jointly adds up to $30,700, which gets added to the capital gains threshold of $89,250, and they total at $119,950. Of course, that threshold is lower for anyone who's filing either single or head of household. Okay, so let's look at a middle scenario here. In this situation, they take a $30,700 IRA withdrawal in addition to the $100,000 capital gains that they incurred. The IRA withdrawal would come through at 0%. Because it would be wiped out by the standard deduction, which is also $30,700. But it would cause $10,500 of capital gains income to be pushed over the $19,950 capital gains threshold, which would then cause them to have to pay the 15% capital gains rate on $10,750 that crossed over the threshold. So they end up paying about $1,612.50. Finally, in the scenario farthest to the right, they take a $50,000 IRA withdrawal. Just like the last scenario, they take the $30,700 of it would still be tax-free because of the standard deduction, but $19,300 of it would now incur ordinary income tax at the 10% rate. Plus, this additional IRA income would also now cause $30,050 of capital gains income to be taxed at the 15% tax rate, because their overall income now exceeds the capital gains zero tax threshold of $119,950. And it exceeds it by $19,300, more than it did in the first scenario, which is only at $10,750 over. This will now cause the overall tax bill to go up to $6,437.50 when compared to the $1,612.50 it was in the second scenario. So with that, you can now see how additional IRA withdrawals can not only increase your ordinary income taxes, but they can also increase your capital gains tax as well. All right, now that we discussed the basics of what the income rules are, how they've changed since the most recent Tax Act was passed, and how both ordinary income and capital gains income can affect each other when it comes to taxes, now let's talk more about how Social Security income is taxed and how it plays into all of this. So with that said, one of the best examples of the counterintuitive nature of how minimum distributions interact with capital gains to create ordinary income is through the taxation of Social Security. If all you had on your tax return was Social Security, you would pay no federal income tax at all. But when you have other types of income, it can cause your Social Security to become more taxable. It's common among advisors to say 85% of Social Security benefits are for most people taxable. And it's true that for high income people, 85% of their benefits are usually taxable and 15% is tax-free. However, for middle and upper middle income folks, that's not always true, because it is based on a formula called the provisional income formula that is provided to us by the IRS, and it can impact everyone's taxes differently depending on the makeup and proportion of your income types. So let's walk through what I mean by that. Bullet point 5, wake up, get the handy dandy notebooks out. The provisional income formula is what is used to calculate how much of your Social Security benefits are taxable. The provisional income formula is what is used to calculate how much of your Social Security benefits are taxable. It works like this. You take half of your Social Security benefits, and then you add 100% of all your other taxable income sources, like pensions, rental income, wages from work. And then you add 100% of all your investment income sources, like dividends, realized capital gains, interest from savings and investments, and even non-taxable interest earnings from municipal bonds. They're not taxable, but they're counted in this formula. And they count towards how much your Social Security benefits are going to tax. The sum of all of this is referred to as your provisional income. So we'll take a look at how that all works in some real life type scenarios soon. But before we do that, let's take a closer look at what the Social Security provisional income thresholds look like and how they work. All right, so now that you know how to calculate your provisional income, in order to figure out how much your Social Security benefits will be taxable, you then have to apply the threshold calculations that the IRS gives us to it to find out. The key here is that only the provisional income that falls over these thresholds creates taxable Social Security. With that said, the best way to demonstrate how this works is by us looking at some examples of it. Before we do that, you need to understand what these thresholds are and how they are applied to your provisional income. So on this slide here, you can see that there is a top black box with only one person in it, which has numbers to the right of that person. They are the income thresholds that apply to a single person. They will first start having 50% of their benefits taxed at ordinary income rates for every dollar they earn over $25,000. Then below that is the amount of income where it steps up to 85% of their benefits being taxed. That, as you can see, is $34,000. Now, with that said, I'm sure that you have deduced that the bottom black box with the two people holding hands in it shows how the thresholds are for married couples, right? See, they're holding hands. All right, let me switch out order. What married people do, right? They hold hands, right? Okay. Now, thus, it's 32,000 where the 50% of their benefits start being taxed, and 44,000 of income or benefits for it to jump up to 85% being taxed. Now, one of the biggest misunderstandings when it comes to this is that many people think that when they cross over to the higher thresholds, that 85% is applied to the full amount of their benefits. But that's not actually how it works. How it works is that 50% of your income that falls between the low and the high thresholds is taxed as ordinary income. And then only 35% of the amount that is above the high threshold is taxed as ordinary income. Then they are added together to come up with the full taxable amount of your Social Security benefit. They're a little tricky. Let's take a look at some of the examples of that in action. Okay. So before we get into this, remember our original purpose for looking at how taxation works for Social Security was for us to see how adding it into the mix of other types of income like ordinary income and capital gains and qualified dividend income can cause each of those types of income to be pushed into their respective tax brackets. However, in these examples that we're about to look at, what we're going to see is how those other types of income can cause your Social Security income to be pushed above the thresholds that we just spoke about. Also, it's worth noting that in these examples, it will only be IRA withdrawals, but it would work the same if it was capital gains, qualified dividends, savings interest, or even non-taxable interest, as well as all other types of income added in. All right. So to do that, we're going to look at two examples, both of which have the same $60,000 of household income, but the proportion of Social Security income to those other types of income, in this case, IRA withdrawals, is much different between the two because it turns out that the ratio between them can make a huge difference when it comes to how much tax is paid on the same gross amount of income. For example, in this top scenario, there's $20,000 of Social Security income and $40,000 of IRA withdrawals. So to determine the provisional income amount, we take half the Social Security and add it to the IRA withdrawals, which comes to $50,000 of provisional income. Then we apply the first threshold for a married couple, which is $32,000. Since that $50,000 is $18,000 over the $32,000 threshold, that means that 50% or $9,000 of that $18,000 that is over the first threshold is taxable at ordinary income rates. Now, when it comes to the second threshold, which is $44,000, that $50,000 is $6,000 over that threshold. And since 85 cents of every dollar becomes taxable here, that creates an additional $2,100 of taxable income. We already picked up the first 50 cents of each dollar in step one, which is why we only multiplied by 0.35 here. In other words, even though we have 60,000 of household income, only 55% of the Social Security benefit is taxable. Now, let's look at the lower example. It still has 60,000 of household income, but this time it's made up of $40,000 of Social Security income and 20,000 of IRA withdrawals. Again, we take half the Social Security and add it to the full IRA withdrawal to get a provisional income of $40,000. But this time, it's only $8,000 over the threshold of $32,000. And since only 50% of it is taxable, that makes only $4,000 of the Social Security benefits in this second scenario taxable income. And it is below the second threshold of $44,000. This means that $36,000 of the total $40,000 is tax-free, and then only 10% of the Social Security benefit in this second scenario is taxable. Because it's only $4,000, it's taxable on $40,000. So as you can see, the higher proportion of Social Security income to all the other income will create a much lower taxable income. As a side note to this, the only type of income that can be had that can be in a higher proportion to Social Security than is any type of income that comes from Roth retirement accounts. That's the only other type of income that can actually have a higher proportion, hold a higher proportion of your income and cause you to pay lower taxes. All right, so now let's tie all this up as it would be on a tax return. All right. When we bring those numbers onto a tax return, we see it's a bit more clear. We see it a bit more clearly. The $40,000 IRA, $20,000 Social Security results in $2,040 in federal income tax. When the $20,000 IRA withdrawal and the $40,000 Social Security income actually creates no federal income tax. One last thing to wrap this up. When it comes to the different kinds of income being blended together, our taxable Social Security income becomes part of our ordinary income, and our total ordinary income amount is then added to our capital gains and qualified dividend income when determining what capital gains bracket and rate our overall income will fall in. So it's very important when we go to draw money from any of our income sources that we do it with a consciousness of how they all relate to each other. Okay, now that we discussed how the different income sources are determined and related to each other from a taxation point of view, and how the rules for some of them have changed and others not so much based on the last tax bill in 2018, now let's switch gears a little and discuss some of the more common ways that the IRS has provided us to reduce our taxes and how some of the rules have changed for them as well. So now let's talk more about various ways that our government gives us to lower our taxes, which is primarily through what are called bullet point six. Bullet point six. Snuck that up on you. Last bullet point. Get the handy dandy notebooks out. They are called, drum roll, tax deductions and credits, which are available to us all. So bullet point six, tax deductions and credits. They're the various ways that our government gives us to lower our taxes on our returns. They've been created mainly to help us reduce our net federal tax bill, but there are some of our states provide us with some as well on top of the federal credits and deductions, but not nearly as many as at the federal level. Now, this is a really big deal because they can effectively make the first several thousands or even tens of thousands of dollars that we bring into our household tax-free. Let's start looking at the deduction first. Okay, when it comes to deductions, what you really need to know is that they are essentially just reductions in our income for certain things we spend money on. You can either track those things, such as mortgage interest, investment interest, local and real estate taxes, gifts to charity, certain types of medical expenses, etc., and complete what they call a Schedule A, which you submit with your annual 1040 tax return. Or if you don't have enough of those types of write-offs, then you just opt to just claim the standard deduction, which we talked about earlier. Most people who used to file the Schedule A form, which is also known as itemizing, before the last tax bill in 2018, but the standard deduction was increased so dramatically by it that now the opposite is actually true. In fact, in 2017, the standard deduction was only $13,000 for a married filing jointly couple, but now it's up to $27,700, which is more than double than it was. As a result of this, only about 15% of the US populations are itemizing their tax deductions at the moment. This is a big deal for retired taxpayers because before this increase in the standard deduction, many of them did not have enough deductions to warrant itemizing on the Schedule A. Meaning that most of them didn't even have $13,000 worth of deductions, and now they are able to reduce their taxable income by at least $27,700 or even $30,700 if they're 65 or older, which is a huge difference. To explain that a little more, the age 65 plus deduction is for both people that reach age 65 or who are blind. The U.S. government now gives everyone that qualifies an additional $1,500 deduction for each for a married couple and $1,850 for a single person. Also, this provision is not new. It was retained in the new tax law and increased $100 from 2022 levels to the present. All right, another drink of water. All right, now let's talk about the tax credits that our government gives us to lower our taxes and to incentivize us to do certain things that it views as healthy for us and our country. Now, the biggest difference between a tax credit and a tax deduction is a tax credit can actually be used to directly reduce our tax bill, where a tax deduction can only be used to lower the amount of taxable income that is used to determine what our tax bill is going to be. Plus, it's also worth mentioning that many tax credits are specifically designed to incentivize behavior that our government encourages us to engage in. Things like paying for our own health insurance, working at a job, going to school to better educate ourselves, saving for retirement, and even building a family by having children. And there are many more that have been created for many other specific reasons. Some are for individuals or families, like the ones I just mentioned, but others are for businesses and other things like disaster relief and charities and things like that. The list really goes on and on. With that said, the two most commonly claimed tax credits today are the healthcare tax credit, which is given to people who pay for their own health insurance, and the earned income tax credit, which is for people who work low to moderate paying jobs that earn between $0 and $63,698 in 2023. That threshold changes every year. They're also probably the most popular as well because they are both what are known as refundable credits, which means like I mentioned in the prior slide, that even if we did not owe or pay any taxes, if we are eligible for these credits, the IRS will actually send us a check for the amounts of whatever the credit's value is. So we get paid for these credits regardless of whatever we paid taxes, whether we paid taxes or not. I'm sure you understand now why people like them so much. Also, a less common tax credit, but one that may be accessible to some people who take a part-time job in retirement, is called the Savers Credit, which basically incentivizes lower income people to save in retirement accounts. So even if you've been a high earner all your life, your tax return may be set up to present you as a lower earner between the point of a formal retirement and the time you are forced to begin taking RMDs, required minimum distributions, from your accounts. So it's possible for us to directly reduce our taxes owed just because we like to save our money. If that isn't motivation to save, I'm not really sure what is. Now, let's look at an example of how these deductions and credits can really help in some situations. This example is of a couple that took in $40,000 of gross income, all of which was classified as ordinary income and had at least $2,000 of income in the form of wages from a job. First, the income is reduced by the married filing jointly standard deduction. Then it's reduced again by the addition of the age 65 plus deduction. Then its last deduction is a $2,000 IRA contribution deduction. Finally, all this leads to a taxable income of $7,300. At this point, our taxable income is then multiplied by whatever our tax rate is, which then determines what amount we owe for our taxes, which in this case is, it's a 10% rate, and it's going to be $730 in taxes. So as you can see, the deduction serves to reduce our taxable income directly and considerably, but they did nothing to actually reduce our tax bill directly. This is where tax credits come into play and are so valuable because when it comes to tax credits, they're different than deductions and exemptions in that they directly reduce the tax bill. In this case, the Savers credit results in a $1,000 tax credit and then reduces our total federal tax bill down to $0. Now, you might be asking yourself, why only $0? This is because the Savers tax credit is a non-refundable tax credit. So it can only be reduced can only reduce taxes down to down the amount that you owe, down by the owed down amount, which is, in this case, $730. $1,000 credit takes you to zero. However, if it were a refundable tax credit, then the IRS would have actually paid out a $270 tax refund in this situation. All right. So I think it's worth reiterating one last time before we move on from our discussion about tax deductions and credits. When it comes to the current standard deduction today, do you remember how this tax map I showed you earlier? Just to make this abundantly clear, there are no taxes that are due for all people that are married and filing jointly on the first $30,700 of income that they claim on their tax return. This is the impact that the new standard deduction, in addition to the age 65 and sight impaired deductions, have had on our current tax liabilities. Prior to this, it was only $13,000 for the same situation. So we should never take our tax laws lightly. With that said, let's now turn our attention to some other major factors that can have a great deal of impact on our taxes in retirement. Now, realistically, if that were all there was to our tax system, it would be relatively intuitive, but unfortunately, in retirement, we see several complicating factors. Each of the factors you see on this slide creates an environment where you expect to pay in taxes, where what you expect to pay in taxes may not be what you end up actually paying. We'll dig into each of these in this section. The first complicating factor is required minimum distributions, also known to most people as RMDs. Most of our clients have saved pretty significantly in 401k or IRA plans over the years. Generally, these contributions were pre-tax on the front end, so all withdrawals come out of ordinary income. Once you reach a certain age, based on when you were born, you are forced to begin taking withdrawals. That age varies based on when you were born. It used to be age 70 and a half, then 72, but for people who are reaching RMD age now this year, it's age 73 if you were born prior to 1960, and it's age 75 if you were born in 1960 or later. The process for calculating these withdrawals is relatively straightforward. Each year, you take the ending balance of all your retirement accounts combined for the prior year, and then divide it by a factor that the IRS gives us that represents your remaining life expectancy. Here's an example of the calculation. This is the chart that the IRS gives us with the life expectancy factors on it that are used each year after you're required to start withdrawing from your retirement accounts. Notice that each year you age, your life expectancy goes down by less than 1 year, such that the table runs all the way out to age 120. And even at age 120, you only have to take out half the prior year's ending balance. No big deal, right? The key here is that if you've done a good job of saving into your IRA, your minimum distributions plus your Social Security may be more than you actually need to sustain the lifestyle you want to live. If that's the case, it's likely you will be paying more taxes on the back end than you could be. And we'll show you in a few slides. Now, when you think about capital gains, if you are like many people, you think 15% tax only when I sell something that appreciated. Not really something to be that concerned about, actually. What many don't realize is that you can recognize capital gains even without selling anything, particularly if you own mutual funds. And now this is called a phantom gain. The best way to illustrate this is with an example. Say a mutual fund A. Whoop, jumped ahead of myself. Okay, the best way to illustrate it is by an example. So, say mutual fund A bought Apple stock in 1985. You bought the mutual fund in 2019 and held it all the way through 2023. In the middle of 2023, the fund manager decides that Apple isn't a good investment value anymore and sells the entire position. Any gain that was recognized on the sale must be passed through to the mutual fund to the current shareholders, even if you didn't participate in any of the gains of that underlying stock. The important thing to remember about capital gains is that if you have invested non-qualified money, even if you are generally a buy and hold type of investor, it is likely you will recognize at least some capital gains in some years. More importantly, when you experience a capital gain on your return, it can have a greater impact than just the tax on the gain, because it increases your adjustable gross income and may cause other deductions to be phased out. For instance, right now, as things stand, anyone who contributes to a company-sponsored retirement plan and an IRA as well can still fully deduct those IRA contributions until their modified adjustable income reaches between $116,000 and $136,000 for a married filing jointly situation. This means that when these income thresholds are met, that their IRA contribution deduction is gradually phased out to zero at the highest range. So as you can see, if a couple that is on the cusp of these income ranges has even a small capital gain occurrence, it could trigger the loss of a valuable IRA deduction. That's why it is good for you to know that it is possible and that it could affect your taxes in some ways that you weren't aware of initially. So now we've covered some of the most common ways that create both confusion and opportunity around taxes and retirement. These last few are things that impact higher income people primarily, but could impact you in a year you do a Roth conversion or have a larger than usual purchase, which causes you to make a larger than usual withdrawal from either your taxable or your tax deferred retirement account. Medicare is now means tested, and these thresholds include your full Social Security benefit. If you fall over the threshold, you could end up paying an extra Medicare Part B and Part D premium. In the scope of your total tax bill, it's probably not much, but it's not insignificant either. These premiums are based on your income from 2 years ago. So it's worth paying attention to the thresholds as you consider how much to take from various accounts. Ain't that the truth, Rach? You know all about that. People paying those Medicare surcharges, right? Again, this is just another potential hidden tax that many people are not aware of. Now, there's also 3.8 net investment income tax also impacts higher income taxpayers. It creates an additional 3.8% tax on net investment income, which includes capital gains and dividends, interest and annuity payments, passive business income, and rents. Basically, if it's not derived from work or a return of your own capital, and it's over the $200,000 limit for single people and $250,000 limit for those that are married, adjusted gross income threshold, it's likely to be subject to this additional 3.8% tax. Of course, this won't apply to most people, but it's worth mentioning just in case it does. for anyone on this webinar today or anybody that you're close to. Okay, the final example of potential tax pitfalls we're going to give here, again, applies only to people who have higher incomes and a lot of deductions. So it's called the alternative minimum tax, or AMT for short, and it's a flat tax system that runs parallel to our normal tax system. Prior to the most recent tax reform, it was estimated that fewer than probably 4 million taxpayers nationally were subject to it. Tax reform significantly actually increased the thresholds and phase outs related to the AMT. So now it actually applies to even fewer people. However, if you're likely to be subject to it, and odds are you'd know if you were, this is definitely an area where you'd want to be working with a good CPA who understands this type of tax situation better than yourself. All right. Since you now have a pretty good understanding of the different income types and how they can affect each other, and the different ways that the government can give us to reduce our taxes, and several of the most common and uncommon factors that can affect our taxes let's now have a brief recap of some of these things and then go through a case study that will demonstrate the impact of indiscriminate spending in both taxable and retirement accounts. All right, the one biggest reason that we all need to have at least a good general understanding of the things that we have covered so far is that in the past, when the government has needed new tax revenues, the method has usually not been to change rates or brackets evenly across all taxpayers. Instead, it's been to introduce phase outs of deductions or exemptions, or begin to include income that was previously not taxable, like Social Security benefits. The result is a tax system in which the most important number isn't necessarily the tax bracket you land in, but instead is the effective marginal rate or bracket that your last dollar falls into. In other words, how much of your last dollar did you actually lose to federal income tax? First, let's revisit the tax map briefly. Remember, as you increase in ordinary income from left to right across the bottom, you can see the rate that should intuitively be applied to the next dollar. Same principles apply when it comes to capital gains. However, when the different income types are blended together, the tax rate that you will pay for every additional dollar spent becomes a lot less intuitive and, frankly, a lot more complicated. So much so that it usually takes a computer software program to figure it out. But it's definitely worth knowing. Let's look at a quick case study to illustrate the idea of effective marginal rates and how they work. We have John and Jane, our nice couple here. They're married, filing jointly, and both over 65. They have $64,000 of combined Social Security income, $10,000 of long-term capital gains this year, and $53,000 of IRA withdrawal. Here's their tax map. You can see that once they take around $14,000 in ordinary income from their IRA accounts, the first dollar after that starts to become taxable. So, because this is an ordinary income chart. So, to clarify how this works on this tax map, it only shows us the amount of ordinary income they're at when they incur the various effective marginal tax rates moving from left to right. It's only showing you the ordinary income they're at. It's not showing you the Social Security or the capital gains income. So when they're at, on this is pretty small, right? Around the 14th, a little over 14,000. on this chart of ordinary income, that's when their tax rates start kicking in. Because remember, they have 53,000 of capital gains, and they also have Social Security income. So it does not show the effective tax rates of their Social Security and capital gains income that are combined with it. But it does factor them all in together as they are realized, and that's how these effective marginal tax rates, moving from left to right, are computed within the program. The result of those computations is the reason why their actual ordinary income, which is represented by the gray area on this map, starts to be taxed at the $14,001 point on the map and reaches the 18.5% effective marginal rate between $14,800 and $26,000 points. It's also because it's at the $14,000 point where the combination of that much ordinary income and capital gains starts to drag enough of the Social Security income into the calculation to begin making every additional dollar withdrawn from their IRAs taxable at 10% until it quickly reaches the point at $14,800 where 85 cents of each dollar of the Social Security starts to be taxable as well, and thus quickly reaches the effective marginal rate of 18.5%. As a result, you can see that this couple barely experiences the 10 and the 12% brackets and end up where this green dot is, which is only $7,000 away from hitting that monster rate of 49.9%. You see the green dot? However, they do ultimately end up in the 22.2% effective marginal tax bracket with the majority of their dollars claimed. With that said, I'm sure that quite a few of you are wondering how it's possible for someone to actually pay 49.9% rate on any part of their taxes. So let's take a look at that. So if you're saying to yourself, well, wait a minute, that spike actually occurred at the 12% or in the 12% bracket, how can that happen? Believe me, you're not alone. Intuitively, this is a couple in the 12% bracket for ordinary income. But you'd expect they did have $1,000 of ordinary income that went just into the 49.9% area inside the 12% bracket for it to only increase 12% of tax, which would be an addition. It's only $1,000 at 12%, an additional $120 in tax. But here's what actually happens. That $1,000 withdrawal did get taxed at 12%. It was $120. But then it caused $850 of Social Security benefits to become taxable, which adds another $102 to the tax bill, which then causes another $1,850 of capital gains that would have come through at zero to become taxable at 15%, which results in another $277.50 in federal income tax. In short, that extra $1,000 IRA withdrawal ends up costing a total of $499.50 in additional taxes due, which is an amount of which is a rate of 49.95% effective marginal tax rate on that small part of that income. Crazy. Super complicated too, right? This is why it's always good to do some tax research before you make any one-time withdrawals from your different retirement and taxable accounts. I want you to see it all laid out. All right, folks. These same principles apply when it comes to the capital gains on your investments as well. If that same couple were considering whether or not to sell a stock that had a $25,000 gain on it this year, don't you think that they would want to know if they were going to lose a larger portion of that gain than they thought they were going to do? They thought they were going to in federal income tax. With that knowledge, they may decide that it makes more sense to only sell part of that stock position this year and another part next year in order to avoid crossing over an effective marginal tax rate threshold and or even move into the next ordinary income tax bracket as well. Again, folks, I'd like to reiterate that you should always do your homework when it comes to potential tax spikes that you could incur when you are withdrawing from any types of retirement and taxable investment account. On top of that, I highly recommend that you give deep consideration from a taxation point of view to when you start taking any type of retirement income sources like Social Security, pensions, and annuity lifetime income payments, because they too may cause a major spike in your taxes that you might have been able to avoid if you time them differently. Okay, folks, I would be remiss if we did not discuss how Roth retirement accounts can play a pivotal role in improving your taxes in retirement. First, just in case there's anyone here who does not know how a Roth account works, let's discuss that quickly. A Roth account is a type of retirement account that allows you to save a certain amount of your post-tax income every year, where the growth on it is tax deferred, just like it is in a pre-tax retirement account, like an IRA or a 401k or a 403b, etc. In fact, just about every type of pre-tax retirement account that exists today also exists in a Roth version of it, which means that there are Roth IRAs, Roth 401ks, Roth 403bs, etc. The major difference between these two types of retirement accounts are that the pre-tax version, which are also referred to as traditional versions, is not taxed before it is invested. It is taxed when you are withdrawing it instead. And the post-tax version, which is known as the Roth version, is taxed before you save it, but then not taxed when you are withdrawing it. It is tax-free at that time. There are several other differences, but for the purposes of this presentation, let's just leave it at that. With that said, you can obviously understand how having a retirement account that grows tax deferred and can be withdrawn tax-free will help to lower your taxes in retirement. The problem is that most of the clients that we have and that we have reviewed over the years either did not have access to a Roth account over the years when they were saving, or were not aware that they did. So most of our clients have most, if not all, of their retirement savings in traditional pre-tax versions of these types of retirement accounts. However, they would love to still be able to take advantage of the tax-free nature of Roth accounts. And one of the major ways that can be done is by doing what is known as a Roth conversion periodically in order to withdraw some of their traditional retirement account savings and move it over to the Roth retirement accounts. With that said, the best way to do that is by finding opportunities when you are planning for your taxes to look for times when you can take advantage of a lower tax bracket by withdrawing extra income right up to the edge of where the next tax bracket or effective marginal tax rate begins. In this slide, John and Jane only took $36,800 in IRA withdrawals this year, which left them exactly $20,000 shy of moving to the next effective marginal tax rate, which in this case was a 49.9% tax rate. This was a perfect time to be able to remove an extra $20,000 from the traditional IRA and move it to a Roth IRA. This is usually how a Roth conversion opportunity is taken advantage of and executed correctly. So this is one of the first things that should be considered when creating a retirement strategy for a client that is either ready to retire now or is not long away from it. However, what's even better than this is when a client is many years away from retirement and a strategy can be put in place now for them to contribute to both traditional and Roth retirement accounts at the correct proportion to where they can take full advantage of paying less taxes now and less taxes later when they retire. Okay, folks, let's sew things up here, man. We're 17 after 8. All right, the fact is that there are a lot of ways to control taxes and to plan in advance to create a tax efficient retirement. The first is to diversify among different account types that have different tax treatment. The second is to use tax deferred accounts where appropriate. The third is to blend your withdrawals from those different types of accounts and income sources rather than to simply spend from them in a sequential order. Okay, the final way to help control your taxes is by paying close attention to the different types of investments you hold in these different types of accounts. It too can make a big difference in the tax efficiency of your retirement income. One of the best examples of this is it usually is better to hold bonds or any type of investments that pays interest or short-term dividends in accounts that are tax deferred, like IRAs or Roth IRAs, instead of taxable accounts like brokerage accounts, because you will be obligated to claim that income from those types of investments as ordinary income on your tax returns every year, regardless of whether you actually withdraw it or not. Okay, folks, that's it for the educational part of our workshop today. I hope that you learned a few things about how things are and how they could be when it comes to your taxes in retirement. I also want to thank you and commend you for taking this time from your busy schedules to learn more about this extremely important topic. I truly believe that it will make a huge difference for you and your family when it comes to preserving your wealth if you implement a good tax mitigation strategy with your retirement plan. With that said, if there is anyone attending this workshop that is interested in this type of advanced tax planning, if you schedule a meeting with me within the next 2 weeks, I'd be happy to create a custom tax map and report based on your situation at no charge. All you have to do is click on the 60-minute meeting link that Rachel has posted in this comment box. Have you posted it?
I'm about to right now.
There you go. And you can go to my calendar once you click on that and book a time that's convenient for you to do so. These are the sources that we use for this webinar. If you're interested in them, Rachel's going to post them as well. Oh, what happened? My slideshow fell apart. Sorry. What the heck? I'm going to have to bounce through these. Sorry. It's cramping my style up here, Rach. It's going to be on my video. Sorry, folks. Man. Oh. Let's tie this thing up. All right, so let's jump into our 6-question questionnaire and do this and get this going. You ready to do this? Now we're going to put the questions where in the chat box, did we say? Are the answers?
Yeah, they should go in the Q&A.
Oh, in the Q&A? Okay. First question. What kind of tax system do we have? Hope I bullet pointed this enough.
Yeah, Amphi got it.
Amphi got it.
Progressive or marginal.
That's right. But send us where you want the gift card from, Am. All right. Second question. Name one type of ordinary income. One type of ordinary income.
Oh, looks like pension wages, right? That Patsy got that.
Okay, pension, yeah. Question 3. What kind of gains are generated from the sale of any type of asset or property that one can own and make money from?
Oh, looks like Lisa said capital.
Capital
Yeah.
gains. Yes. Lisa, please let us know where you'd like your gift card in. Just pop that on that too. Number 4. Name one of the 2 main capital gains tax rates.
I'll see. Amphi got it. It's 15%.
That's
15
right.
on 20, but she said 15.
That's it. What is number 5? What is the name of the formula that is used to calculate how much your Social Security benefits are taxable and takes half your Social Security and adds all other income sources to it?
Let's see. Yeah, Patsy said provisional.
That's right, Patsy. Good job.
Hmm.
Final question. Name one of the 2 primary ways the government gives us to lower our taxes.
Let's see. Deductions. Amphi said deductions. Yep. Deductions. So because the answer was deductions or credits.
Yep. Dan always kills it.
Mhm.
All right. Any questions in there?
Yep. Let's see. It looks like I think there's a couple in the Q&A here and then a couple from the email. So in the Q&A box, one was what if your IRA is a Roth IRA? Does that make a difference?
Oh, difference in your taxes? Absolutely.
Yeah.
Yeah, if you have a Roth IRA, especially if you have the bulk of your assets in a Roth IRA, you're going to pay a lot less taxes, especially when you do like those one-time withdrawals for larger purchases.
Okay, and then there's another one. Are payments from an annuity considered ordinary income?
Absolutely. Even if it's actually, it's a good question in a sense, because if the assets that came from an IRA are and it came that were invested into an annuity came from an IRA, it's still ordinary income. Believe it or not, though, if the assets came from a non-qualified account or a taxable account, it depends on how you take that money from an annuity. If you annuitize that annuity and you take systematic payments for the rest of your life, say it's not done through an income rider, they actually have a formula that they use where some of it is return of your cost basis, and some of it is actually your appreciation. But if you take an income rider and you activate an income rider on non-qualified funds, that's going to be all ordinary income. So,
Okay.
yeah.
All right. Then a few in email here. If a couple both maxed out their Social Security income to age 70, will that cause their taxes to be higher than if they took it earlier?
Tricky question. Tricky question. Actually, do you remember the scenario we talked about where the couple had 40,000 and the one scenario they had 20,000 in Social Security and 40 in capital gains or IRA withdrawals? Well, and the one who had the lower Social Security paid the higher taxes. Believe it or not, the higher Social Security usually causes lower taxes.
Okay. So another one here. What do you think is the best approach to dealing with one-time expenses in retirement? Like a new roof or a new car?
That's a good one. That's a heartbreaking situation sometimes. When I have clients that save the majority of their assets in, if not all of their assets, in like IRAs or 401ks, or they're originally 401ks and we rolled into IRAs. If you go to, if you pull 20,000 to put a new roof on, I mean, that could cause you to really spike not only your taxes, but you actually could take an increase in your Medicare and other types of things that it could cause. In those instances, a lot of times, believe it or not, I'll say to a client, "Hey, look, why don't you take a home equity line of credit out and then we'll take the money out systematically to pay off that home equity line of credit out of their qualified funds, like over 2 or 3 or 4 years, whatever, just to keep them under those bracket thresholds." But if they have Roth or they have sometimes non-qualified or taxable, a decent amount of taxable income, remember those cap and they have low Social Security, whatnot, and then remember it's up to $89,250 of tax of that threshold on capital gains. So sometimes you could even use the money, take it right from a taxable account and pay nothing. So and then of course if you have a Roth, then obviously it's all cake there because you're not going to pay anything. So, but there are like the few different approaches that when people are in retirement that we kind of go by.
Okay. There's a couple more here. Does it always make sense to do a Roth conversion to lower taxes in retirement?
Always? No, it doesn't always make sense to. You have to catch certain windows of time, like a time where it can be beneficial is from the time like someone first goes into retirement. Say if they retire at say 65 or 66, even 67 now, and now you're not taking required minimum distributions to 73, or later date it'll be 75. You could have a good 5, 6, 7, 8 years before you're required to start removing money. And depends on what your overall income is up to those brackets we were talking about. But it could really make a lot of sense during those years to take out up to the bracket, and then maybe Roth convert it. That could make a lot of sense to prepare for those later years. And then maybe you might have hospital bills. You might have stuff where you need those bigger expenses later on. You want to have a nice little nest egg of money that's non-taxable. So that's, but it doesn't always make sense. Sometimes I've met clients and it's like they might be 71, and then have 2 years before it. And just, they can't really make up for the amount they had to pay in taxes in their lifetime to make up for it. So it doesn't always make sense. No.
All right, one more here. Does it make sense to exclusively save in Roth retirement accounts?
So that is what a lot of people think. And it seems like logical, right? That, if I have all this money saved in these non-tax, bull accounts, tax deferred, yeah, I should just use it as much as possible. The thing is, sometimes people, they have to kind of forecast what your income is going to be like in retirement. If your income's going to be pretty low, or relatively low, you may not be paying very many taxes at all. So if you're not going to be paying very many taxes anyway, why pay taxes on that money now to save in a Roth when you can save the taxes on it, and then your income threshold is going to be low enough to be hardly paying anything later? And so it may make more sense to be in traditional at that point. But there's also ways to strategize where, you're always going to have that some type of standard deduction. Hopefully it'll stay at this level or can get bigger. So you're going to have some part of your money that's going to be tax free. So you can always save up, in tax, in IRA qualified, accounts, tax deferred accounts, at least some portion that you're going to be able to take out up to $30,700 a year out of it, tax-free anyway, and then pay, no taxes on it when you put it in, and then maybe thereafter save it in Roth or the combination between Roth and taxable accounts.
All right, that was it. Yeah.
All right, cool. All right, folks. Let's see. All right. So if you have any questions in regard to any of these topics, folks, or in general about any of the financial matters, any other type of financial matters, we'd be more than happy to discuss them with you as well in a complimentary 15-minute Q&A phone call. Rachel's going to post. Did you post that one too, Rach?
I did. It's in there.
She's going to post that link as well. So, or if you even want to call just to talk a little bit about, to find out more about something before you want to schedule a 60-minute, whatever, that's fine too. You also, so you could find our, you can find all these links on our website as well. Okay, so if you don't catch these links, go to our website at plcfs.com. There's a book now, link on the top of every page, and to schedule a meeting on every page. You can even click on contact us. All the navigation is always there. You can also call us at 215-804-9708, and we'd be more than happy to discuss whatever's on your mind with you directly on the phone. People do it still sometimes.
Once in a while.
Right? Also, folks, please mark on your calendar Tuesday, December 19th. It's not the last Tuesday of every month. We usually do the last Tuesday of every month, but not next month. Why not? Because of it being Christmas week. And so for myself, Brian Dougherty, and my wonderful, beautiful partner in business and life, Rachel Dougherty of PLC Financial Solutions, located in the Fort Washington area. Have a great end of your month and a very merry holiday season. We will see you next month. Say goodbye, Rachel.
Have a great night, everybody.
Bye-bye.